Welcome to Debt Matters. Today we're looking at the UK housing market, but probably not from the angle you're used to seeing in the headlines. There are some fresh signals coming out, specifically around house prices and buyer activity. And it suggests the market is shifting.
It is shifting. Yeah.
But it's not a boom, definitely
Yeah.
not a sudden transformation or anything like that.
No, not at all. It's what economists love to call green shoots.
Right.
But we need to be really careful with that phrase. In the context of debt, green shoots can sometimes look a lot like weeds if you aren't paying close attention.
That's a good way of putting it, because usually green shoots means everything's fixed, problem solved. But looking at the new survey data from the Royal Institution of Chartered Surveyors, the RICS data, that's not really the story, is it?
No.
The story seems to be less about things getting good and more about things getting less bad.
Less negative is the exact phrase I would use. And that distinction is, well, it's vital. We aren't seeing a recovery in the sense that prices are soaring or arrears are just vanishing. We're seeing a stabilization. The bleeding has slowed.
And that sounds kind of boring.
It does, but in the world of collections and household finance, the difference between a market that's crashing and one that's just stagnating it's massive.
So our mission here is to figure out what that stabilization actually looks like for a normal person's bank account.
Exactly.
Because if the market is just steadying, that changes how people handle their debts, how they prioritize bills.
And whether they decide to answer the phone when a creditor calls.
Yeah.
We need to look past the headline of recovery and understand the mechanics. Because when the market goes from terrifying to just subdued, human behavior changes. And that is where the financial risks can actually hide.
Okay, so let's start with the data itself. What are the actual numbers we're looking at here?
The main metric to watch is the house price balance. It's currently sitting at minus 10%.
Minus 10. So hold on. It's still a negative number.
It's still negative. And what that means is that 10% more surveyors are seeing prices fall than are seeing them rise.
So the majority are still saying, yeah, prices are softening.
Correct. And that is why we can't call this a boom. But, and this is the crucial part, last month, that number was minus 13%.
So it's improving.
It's improving. The intensity of the pessimism is lifting. We are moving from a steep decline to a much gentler slope.
It's like the difference between slamming on the brakes and just, coasting. You're still slowing down, but you aren't lurching forward.
That's a perfect analogy. And we see the same thing with buyer inquiries.
Okay.
That metric is at minus 15%. Again, negative. But it's up from minus 21. It's the highest it's been since July.
So fewer people are ghosting their estate agents.
Exactly. There's a little more curiosity, a little more engagement. People are starting to ask, well, what could I buy? Rather than just assuming they can't afford anything.
And I saw a mention of optimism for sales over the next 12 months.
Yeah.
That it's hitting a high.
Yes, the 12-month outlook is the most positive it's been in a long time. But we have to apply a reality check here. The word RICS used repeatedly was subdued.
So gradual.
Yeah.
Not a sudden spike.
A very gradual shift.
Okay, so baseline established. The market is less negative. Why does that matter for someone's debt? If my house isn't suddenly worth a fortune, how does this change how I pay my bills?
It all comes down to the psychology of repayment.
Right.
Market sentiment is directly correlated with how people prioritize their money. When the headlines are full of crashes and price drops, people panic. And panic-driven arrears are a very specific thing.
That where people just freeze up, the whole ostrich head in the sand thing?
Precisely. We call it going dark.
Going dark.
Yeah. When a debtor feels the walls are closing in, their biggest asset is losing value, the economy is tanking, they stop responding, stop opening the mail, stop answering the phone, they just hoard cash.
That makes sense. If you think the ship is sinking, you don't worry about the bar tab, you worry about the lifeboats.
That is exactly it. But when the news shifts to things are stabilizing, that terror, it recedes.
Okay.
When people feel conditions are improving, or at least not getting worse, they prioritize keeping the roof over their heads. They prioritize the mortgage, the rent, the council tax. They're more willing to engage.
So the less negative data actually clears the mental fog for people.
It does. Stabilization leads to fewer of these dark accounts. People are more willing to make repayment plans when they aren't so terrified.
But the nuance here is that improving doesn't mean their budget is suddenly easy.
Not at all. Their wages haven't necessarily gone up. Inflation is still there. but the willingness to communicate changes.
That's a critical distinction. They don't have more money, they just have more bandwidth to deal with the problem.
Yes.
But there's a flip side to this confidence, isn't there? You said before that optimism can be a bit of a trap.
It's the double-edged sword of a recovery.
Yeah.
When buyers believe the market has stopped sliding, it triggers spending.
The wealth effect economists talk about?
To a degree, yes. Even if your house hasn't gone up in value, the fact it's not going down makes you feel a little bit wealthier, a bit safer.
And when you feel safe, you make plans.
You start making plans, you might decide to finally move or renovate the kitchen.
And those things cost money.
A lot of money. Repairs, furniture, fees, removal vans. And because households have been squeezed for so long, they often don't have the cash savings to pay for it all up front.
So it goes on the plastic.
It goes on credit cards, overdrafts, buy now, pay later. We see a rise in credit demand when confidence returns. And this creates what we call the delayed wave for collections.
Walk me through that timeline.
Okay, so the housing market stabilizes in February. People feel good. They book the builder or the movers in March. They max out the credit card to pay for it.
Right.
By, say, September, the interest rates on that card bite and the unsecured arrears start to tick up.
So the housing market steadies, which helps the mortgage lenders, but it potentially hurts the credit card companies 6 months later.
That's it. Households stretch themselves to make the move or do the renovation because they feel optimistic, and then the bill lands. And if you're already on a tight budget, that surge in confidence-based spending can lead to real trouble.
That really connects the dots. The economy almost creates a false sense of security just to get you spending again.
That's effectively how consumer confidence works. It's a self-fulfilling prophecy until the cash runs out.
Let's pivot to the rental market. We've talked about homeowners and buyers. How does this less negative news affect landlords and tenants?
Well, it affects them massively. This is where it gets tricky for renters. We talked about sales optimism rising.
Yeah.
So if you're a landlord and you've been holding on to a property you wanted to sell, but you were waiting for the market to improve, well, these green shoots might be your signal to exit.
Right. The accidental landlords, the people who couldn't sell last year, so they just rented it out. Now they see these numbers and think, great, I can finally sell.
Exactly. Some may decide to sell, others might refinance or just adjust their portfolios. For the landlord, it's a rational business decision. For the tenant, it's disruption.
And disruption usually leads to money problems.
It creates instability. If a tenant thinks they're going to be told to leave because the house is being sold, their financial behavior changes. They might stop paying rent to save for a deposit on a new place.
Or there's just confusion and payments get missed.
It's a chaotic period. This transitional time, when the market starts to move again, is actually when arrears processes are most critical for agents. You can't just assume the rent will keep coming in.
It seems like that would be the time you want to be talking to your tenants most, not just sending an automated email.
Precisely. You need early contact, clear payment plans, and specifically, you need to be documenting vulnerability, because if a tenant is being forced to move, they are, by definition, in a vulnerable position. Ignoring that just leads to bad debt.
Let's broaden the scope a little bit. We've covered households. What about businesses, the local economy? Tradespeople, suppliers. How does this housing data affect them?
Housing activity is a massive engine for local cash flow. Think about it. When a house sells, it's not just the estate agent who gets paid.
It's the removal company, the decorator, the hardware store.
The carpet fitter, everyone.
So in theory, green shoots in housing should be good news for local businesses.
It is good for the order book. More work means more invoices. But, and here's the warning, it also creates new trade credit exposures.
Explain that for us.
Well, let's say you're a timber merchant. Suddenly, the local builders are busy again. They're coming in, taking materials on account, put it on the slate. I've got 3 jobs on.
Your sales figures look great on paper.
They look great, but you haven't actually been paid yet. There's a lag. And this can lead to a phenomenon called overtrading. It's where a business actually goes bust because it expanded too fast.
Wait, really? Insolvencies can go up when things get better.
It happens constantly. A business takes on too much work, buys too much stock on credit, pays its staff, all before the customer actually pays the invoice. They run out of cash trying to fulfill the new orders.
So the advice for the business owner listening is, what? Be a pessimist.
Be a cynic, or at least be a strict banker. Just because your customers are optimistic doesn't mean they have the cash in the bank yet. We advise businesses to tighten credit control now, precisely when customers are feeling good.
That is so counterintuitive. When things are looking up, you want to be generous, capture that market share.
Optimism doesn't pay bills. Cash does.
So we have a pretty clear picture. The market's shifting, behaviors are changing, and there are risks lurking in that optimism.
Let's pivot to the toolkit. What should people actually do? Let's start with households.
For households, the message is discipline. Use these green shoots as a chance to stabilize the budget, not expand it.
So resist the urge to book the builder. Unless you have the cash in hand, yes. List your priority bills, set the payment dates, and the crucial advice. Contact creditors early if you're feeling strain. Don't wait. Use that window when creditors are more open to engagement.
And if someone's already behind, if they've been going dark,
Ask for a structured repayment plan in writing. And make sure you stick to one that's actually affordable. Don't promise what you wish you could pay. Promise what you can pay.
okay. What about for landlords and agents? You mentioned process is key.
Build a simple arrears timeline and do not let things drift. If rent is due on the 1st, a reminder goes out on day 1. A personal follow-up on day 7. By day 14, you should be presenting payment plan options.
It sounds rigid.
It's necessary. It establishes clear triggers. And as I said, keep vulnerability handling consistent. It protects the tenant, and it protects the landlord from long, drawn-out disputes.
And finally, for the SMEs, the tradespeople and suppliers, what's the tactical move there?
Refresh your credit checks. If you have customers linked to housing builders, property managers check their limits. Just because they were good for $5,000 last year doesn't mean they are today.
And for new work.
Tighten the terms. Use staged payments. Ask for deposits up front. Outline clear consequences for late payment. It's much better to have a slightly awkward conversation at the start than chase a debt 3 months later.
It really does seem like the theme here is caution amidst optimism.
That's a fair assessment. The numbers are less negative, and that signals a shift in behavior. But we are not out of the woods. We're just in a different part of the forest.
It makes you think. We spend so much time looking at these national charts, the house price balance, the inflation rate, waiting for them to tell us we're okay.
We do. We look for external permission to feel secure.
But there's a huge difference between market recovery and personal financial recovery. Just because the charts are stabilizing, does that mean the average household balance sheet is actually healthier?
Or are we just feeling more confident about being in debt? That's the question everyone should be asking themselves this week.
Thank you for listening to Debt Matters. We will see you next time.